Hello friends, in this video I'm going to discuss the steps in the accounting cycle. So the learning objectives of this video are to understand the basic accounting terminology, explain double entry rules, identify steps in accounting cycle, record transactions in journals, post to ledger accounts, and prepare a trial balance. Explain the reasons for preparing the adjusting entries, prepare the financial statements and adjusted trial balance, prepare closing entries. The accounting is all about debits and credits. An account shows the effect of transactions on given asset, liability, equity, revenue, or expense account. Double entry accounting system means two-sided effect. The equation always have to be in balance, and the equation is assets equal liability plus owner's equity. Recording done by debiting at least one account and crediting another. The debits must always be equal to credits. Debits and credits are the arrangement that show the effect of transaction on an account. Debit means left side and credit means right side of the account. In accounting, we always manage the accounts with the T accounting form, and the T account, the left side of the T is the debit side and the right side of the T is the credit side. Now let's discuss the normal balances of each kind of accounts. The assets usually have normal debit balance. Expenses usually have normal debit balance. Liabilities have normal credit balance. Equity have normal credit balance. And revenue also has normal credit balance. The asset account is increased by debits and decreased by credits. Expenses also increase by debits and decrease by credits. Liabilities increase by credits and decrease by debits. Equity account also increases by credits, decreases by the debit. Same, revenue also increases by credits and decreases by the debits. This slide shows the accounting equation in an expanded form. We all know that the balance sheet shows the assets, liability, and equity. And on the income statement, we see the revenues and expenses. Asset equal liability plus owner's equity. And if we expand this equation, the equity is increased by the revenue and decreased by the expense. In order to keep the equation always balancing, the debits must always be matched with equal amount of credit. It means that if we have increased our asset account, then we will put the amount on the debit side. And there should be a credit to the other side of the equation for that amount. Let's take an example. The company received cash from the customer, so the cash goes up. Now, when the sales were previously made, we recorded the account receivable, which is also an asset account. So the customer paid $200. We increased our cash by $200, and we will decrease the account receivable by $200, and the account receivable is decreased by the credit. So the equation is in balance. Let's talk about the relationship among assets, liabilities, and equity of a business. The basic equation is assets equal liabilities plus equity. Expanded equation is assets equal liabilities plus owner's equity plus retained earnings minus dividends plus revenues minus expenses. The equation must be in balance after every transaction. For every debit, there must be a credit. Let's look at a double entry system example. A sole proprietor invests $40,000 in exchange for share capital. That means the asset cash increased by $40,000. And because the owner has invested the money, the equity has increased by $40,000. Now let's say that the company has purchased the office equipment for $5,200, giving 10% promissory note in exchange. So the asset, equipment, has increased by $5,200. Because the equipment was not purchased by paying cash but by the note, so there is a liability. So liability has also increased by the $5,200. Now just notice that the assets increase on debit side and liabilities increase on credit side. So on the asset side we have a debit of $5,200, and to balance that equation, on the other side we have a credit of $5,200 in liabilities. The company received $4,000 cash for the services rendered. The cash has increased by $4,000. It means the cash has been debited for $4,000. Now if the cash is debited, there has to be a credit entry. Now when the cash is received for the services rendered, it means that it's a revenue for the company, and the revenue increases the equity account. That's why there is a credit of $4,000 in equity. The company pays off short-term liability for $7,000. This means that the liability has been reduced by $7,000, and we reduce liabilities by debiting it. So the liabilities are decreased by $7,000 and the asset is credited for $7,000 because we have paid. So the asset is also reduced by $7,000. The company declared cash dividends of $5,000. Because the dividends are declared, so the liability to pay them has been increased by $5,000, which will be dividends payable, credit $5,000, and the equity has been reduced by $5,000. It means it will be debited by $5,000. The company paid $16,000 cash for a van. So company purchased a van, which is an asset for the company, and it had paid cash to purchase it. So the cash has been reduced, credited for $16,000, and the other asset, van, has been increased, debited by $16,000. Now this transaction has nothing to do on the other side. The assets were reduced and increased at the same amount. Let's talk about the accounting cycle. The accounting cycle starts with the transactions or business events. Step 1 is to journalize those transactions, means to record them in the general journal. Step 2 is to post those journal entries into the general ledgers. Step 3 is to prepare unadjusted trial balance. Step 4 is to make end of the period adjustments. Step 5 is to make adjusted trial balance. And usually a worksheet is used by the accountant to make the adjustments and to come up to the adjusted trial balance. And from that adjusted trial balance, the financial statements are prepared. The first statement that is prepared is the income statement. From the income statement, the net income is taken to the balance sheet, the equity side, and then the balance sheet is prepared. After the financial statements are prepared, the closing entries are made. And step 8 is post-closing trial balance. And step 9 is reversing the entries. And that's how the whole cycle is complete. And next period, the cycle will again start with the new transactions. Here are the different phases of accounting. Phase 1 is called recording, in which we collect and analyze the data from transactions and events, and we journalize those transactions. The second phase is called classifying phase. In this phase, we post the transactions or the journalized transactions into the general ledger, and we prepare the unadjusted trial balance. Phase 3 is the summarizing phase. In this phase, we prepare the adjustment entries, we prepare adjusted trial balance, financial statements, we close the temporary accounts, prepare the post-closing trial balance, and we reverse the entries. Phase 4 is the analyzing or interpreting phase. This is the phase that is after the financial statements are prepared. So in this phase, we actually analyze the profitability, liquidity, solvency of the company, how well the company is doing. Let's talk about the first step of the accounting cycle: identify and recording transactions. What to record? An item should be recognized in the financial statements if it is an element, is measurable, and is relevant, and has a faithful representation. Journalizing. General journal. General journal is a chronological record of transactions. Journal entries are recorded in the general journal. For example, September 1, shareholders invested 15,000 cash in the corporation in exchange for ordinary shares. So the cash is debited by 15,000 and the capital share is credited by 15,000. Here the debit in cash means increase in cash, and credit in shareholder capital means increase in the shareholder capital. Because cash is the asset, it's on the left side of the equation, and the shares capital is the equity account, and it is on the right side of the equation. So if the cash is debited, the shares capital is credited and the transaction is in balance. Posting. Posting is the process of transferring amounts from the general journal to the ledger accounts. Every asset, liability, and equity accounts have their own specific general ledger. Once all the transactions have been posted to the general ledger, the trial balance can be prepared. Trial balance is actually the list of each account and its balance. It's used to prove the equality of debit and credit balances. Adjusting entries. Adjusting entries makes it possible to report on the statement of financial position the appropriate assets, liabilities, and equity at the statement date. Report on the income statement the proper revenues and expenses for the period. And as per the matching principle, revenues are recorded in the period in which they are earned, and expenses must be recognized in the period in which they are incurred. Types of adjusting entries. There are two main categories of adjusting entries: deferrals and accruals. Deferrals. Under this comes prepaid expenses, which are assets, and unearned revenues, which are liabilities. Prepaid expenses. They are the expenses that are paid in cash and recorded as assets before they are used or consumed. Unearned revenues are revenues received in cash and recorded as liabilities before they are earned. Accruals. Accrued revenues. Revenues that are earned but not yet received in cash or recorded. Accrued expenses. Expenses incurred but not yet paid in cash or recorded. So, deferrals are either prepaid expenses or unearned revenues. Prepaid expenses are assets. We record them in assets when we pay for them. The example is insurance. For example, the company pays for insurance for 3 years, and now it has consumed 1 year of insurance. So it will credit the asset account and record the expense for that amount. Unearned revenues are earned at the end of the accounting period, or the portion of it is earned by the end of accounting period. So we will reduce our liability by debiting it, and we will increase the revenue by crediting it. Some of the examples of adjusting entries for prepaid expenses are insurance, supplies, rent, advertising, purchasing buildings and equipments. Now, prepaid expenses are the payment of cash that is recorded as an asset because a service or benefit will be received in future. So cash payment is made before the expense is actually recorded. Let's see an example for prepaid expenses. The company purchased supplies worth of $25,000 at the beginning of the year. And then at the end of the year, when the counting was done, it was found out that the supplies worth of $10,000 are left. They are on hand. It means that the company has used $15,000 worth of the supplies. So the company will make the adjusting entry. It will credit $15,000 and will increase the expense account by debiting it for $15,000. And you will see that after the adjusting entries are made on the balance sheet, the supplies will be at $10,000. It has been updated. The account has been updated by the adjusting entry. And this is the income statement side of income statement. And over here also you will see that the supplies expense is $15,000. Means we have taken into effect the $15,000 expense to match it with the revenues. Let's talk about unearned revenues. Unearned revenues means receipt of cash that is recorded as a liability because the revenue has not yet been earned. It means the cash is received before the revenue is recorded. Unearned revenues often occur in regard to rent, airline tickets, school tuition, magazine subscriptions, or customer deposits like a membership. Here is an example of unearned revenue. Pioneer Advertising received $12,000 on October 2 from KC for advertising services expected to be completed by December 31st. Show the journal entry to record the receipt on October 2. So on October 2, when the cash was received, we debited cash by $12,000, which means we increased the cash by $12,000, and we also credited the liability. Unearned service revenue is a liability account and it sits in the liability section of the balance sheet. We increased the liability account by crediting it for $12,000. After analyzing the records, it was revealed that Pioneer earned $4,000 of the advertising services in October. Thus, Pioneer makes the following adjusting entries. It will debit the liability account because the liability has reduced. The company has earned this much of the money. So it will reduce the liability by debiting $4,000 and increase the revenue account by crediting it. Adjusting entries for accruals. Accruals are either accrued revenues or accrued expenses. What does the word accrued means? Accrued means outstanding. Outstanding revenues means that the company has earned the revenue but it hasn't invoiced the customer. Accrued expenses means that the company has used, for example, the company has used the utility but haven't paid for it. Adjusting entries for accrued revenues. Revenues are earned but not yet received in cash or recorded. The adjusting entry results in revenue recorded before the cash is received. Accrued revenues often occur in regard to rent, interest, and services performed. Here is an example of accrued revenues. In October, Pioneer earned $2,000 for advertising services that it did not bill to clients before October 31st. Thus, Pioneer makes the following adjusting entry. Account receivable is increased by $2,000, means the money has not yet been received, and the service revenue is increased by $2,000. Accrued expenses. Expenses that are incurred but not yet paid in cash or recorded. Expenses are recorded before cash payment. So, accrued expenses often occur in regard to rent, interest, salaries, and taxes. After all the adjustments are made to the accounts, we can prepare adjusted trial balance, which is the accurate trial balance for the period. It shows the balance of all accounts after adjusting entries at the end of the accounting period. The financial statements are prepared directly from the adjusted trial balance. Income statement is prepared first, then the retained earnings statement, and then the statement of financial position. Now there is a reason why income statement is prepared first. From the income statement, you get the net income or net loss. And then that net income or net loss is posted to the retained earnings statement. and the retained earning is taken to the balance sheet on the equity side. So if the retained earning is not prepared, the balance sheet cannot be completed. And if the net income or net loss number is not derived, the retained earnings statement cannot be completed. So income statement has to be prepared first. Let's talk a little bit about closing entries. To reduce the balance of the income statement, revenue and expense accounts to zero. Please note that the income statement accounts revenues and expenses are nominal accounts, and they're also called temporary accounts. At the end of every period, their balance has to be zeroed out. The transfer of net income or net loss is taken to the equity. Statement of financial position, asset, liability, and equity accounts are not closed. They are permanent accounts. So balance sheet accounts are permanent accounts, and income statement accounts are the temporary accounts. Dividends are also closed directly to the retained earnings account. In order to do the closing entries and to close everything to the balance sheet, a temporary account is created, which is called income summary. If you look at the closing entries here, you see that the revenues has a normal credit balance. So how it will be closed to zero? By debiting the whole amount. So when the sales revenue or the service revenue is debited, we credit the income summary account to close the revenue account. And the same is done with the expenses. Expenses usually have the debit balance. So all the expense accounts are credited to bring it to zero, and the total is debited to the income summary. After that, the income summary is closed to retained earnings. We find the difference of the debit and the credit side of the income summary. And we close out the income summary and we take the balance to the retained earnings. And then the retained earnings are reduced by the dividends, and the dividend account is credited to close the dividends to the retained earnings. After that, the post-closing trial balance is created. And this is what is used to prepare the financial statements. Reversing entries. After preparing the financial statements and closing the books, a company may reverse some of the adjusting entries before recording a regular transactions for the next period. Let's review the accounting cycle. Enter the transactions of the period in appropriate journals. Post from the journals to the ledger or ledgers. Take an unadjusted trial balance. Prepare adjusting journal entries and post to the ledger. Take a trial balance after adjusted trial balance. Prepare financial statements from second trial balance. Prepare closing journal entries and post to the ledger. Take a trial balance after closing. Post-closing trial balance. Prepare reversing entries, optional, and post to the ledger.